Today's first story is about a significant shift in the Canadian mortgage market. It seems that fixed-rate mortgages are becoming more affordable due to a drop in bond yields. This trend is causing excitement among potential homebuyers who are eager to lock in lower rates. Let's break this down a bit further. According to recent reports, the decline in Canadian bond yields has led to a reduction in fixed mortgage rates. This is a big deal because bond yields are often used as a benchmark for setting fixed mortgage rates. When bond yields fall, it typically causes fixed mortgage rates to drop as well. This is great news for anyone looking to secure a fixed-rate mortgage, as they might find themselves with lower monthly payments and overall interest costs. The term radically less has been used by some experts to describe the current situation with fixed-rate mortgages in Canada. This phrase highlights the significant decrease in rates that we're seeing. For many Canadians, this could be an opportune time to consider buying a home or refinancing their existing mortgage to take advantage of these lower rates. It's important to note that while lower fixed-rate mortgages are generally positive for borrowers, there are potential downsides. For instance, if the economy starts to pick up and inflation rises, bond yields could rebound, leading to higher mortgage rates in the future. Therefore, it's crucial for borrowers to consider their financial situation and long-term plans before making a decision. In summary, the drop in bond yields is currently making fixed-rate mortgages more attractive in Canada. While this provides an opportunity for savings, it's essential for borrowers to stay informed about possible economic changes that could affect these rates. As always, consulting with a financial advisor or mortgage broker can provide additional guidance tailored to individual needs. Let's shift our focus now to the best 5-year variable mortgage rates in Canada. Recently, there's been a lot of movement in the variable mortgage market, largely influenced by the Bank of Canada's monetary policy decisions. As of February 2025, the Bank of Canada has reduced its overnight rate multiple times, including a recent cut on January 29th, which caused a 25 basis point dip in variable mortgage rates. This brings the lowest advertised variable mortgage rates in the country to below 4.1%, although major banks are offering rates closer to 4.5%. For those unfamiliar, a 5-year variable mortgage rate means that your interest rate can fluctuate throughout your loan term. Unlike fixed-rate mortgages, where the interest rate remains constant, variable rates can go up or down depending on economic factors like the Bank of Canada's overnight rate. The main appeal of variable rates is their potential to be lower than fixed rates, especially if the Bank of Canada continues to lower its rates. However, this also comes with the risk that rates could increase if economic conditions change, such as a rise in inflation. A study by the Bank of Canada showed that payments for variable rate mortgages opened in February 2022 had risen by 70% by November 2023 due to rate increases. So, what's the best variable mortgage rate? Well, it's not a one-size-fits-all answer. The best rate depends on your financial profile, including your credit score, income, and existing debts. Therefore, it's crucial to compare rates from various lenders to find the one that best suits your situation. Historical trends show that comparing today's rates to the past can be misleading. For instance, what seemed like high rates in 2019 might seem favorable today. Rates fluctuate based on economic conditions, so it's important to keep an eye on the current market landscape rather than relying solely on historical data. Looking ahead, whether variable rates will continue to decrease in 2025 depends on the Bank of Canada's future actions. The bank might reduce its overnight rate further if economic conditions allow, potentially bringing variable rates down by another 0.5%. However, larger cuts will depend on the economy's performance, including the impact of any U.S. tariffs. For anyone considering a variable rate mortgage, it's important to weigh the pros and cons carefully. While these mortgages generally offer lower rates and prepayment penalties, they come with unpredictability. If rates rise, your payments could become unaffordable, and switching to a fixed rate might not be feasible for everyone. Ultimately, choosing between fixed and variable rates requires careful consideration of your financial situation and risk tolerance. If you're confident that rates will remain stable or fall, a variable rate might be beneficial. However, if your budget is tight, a fixed rate could provide more financial security. Based on the latest statistics from the Canada Mortgage and Housing Corporation, it appears that construction projects for new homes in Canada are set to decline over the next few years, although they will remain above the 10-year average. In 2024, the federal government had predicted that more than 500,000 new houses would be under construction annually until 2031. However, the Canada Mortgage and Housing Corporation's figures suggest a different outlook, with fewer than 250,000 new homes expected to be built in 2025, less than 240,000 in 2026, and fewer than 235,000 by 2027. Cassandra McMullen, who is planning to move her family from Grand Prairie, Alberta to Nova Scotia, is finding it challenging to locate a suitable home. McMullen commented, "Even if they build those new houses, we would not be able to afford a new build." She explained that due to the pricing and limited options, her family cannot be overly selective about their next home purchase, stating, "We have to look at the entire province and find the house that fits us. And we're going to have to deal with being in the province, even if that is not close to family." The Office of the Minister of Housing, Infrastructure and Communities in Canada has assured CTV News that the government is closely monitoring the Canada-US trade landscape and is focused on protecting national interests, particularly concerning the housing market. This assurance comes amidst concerns about the potential impacts of international trade tensions on the Canadian economy. Halifax-based commercial and residential developer Wadi Fairs has noted that while the Goods and Services Tax and Harmonized Sales Tax holiday has positively impacted the construction industry, other factors such as labor shortages and overseas supply chain issues have caused slowdowns. Fairs also highlighted the potential effects of immigration policy changes and a looming trade war, saying, "And the interest rate is also still very high. So really projects are coming in at a very high cost. It is becoming a bit less viable for developers." Despite these challenges, the Canada Mortgage and Housing Corporation reports that detached and semi-detached homes continue to be built at a high rate, particularly affordable row houses. The corporation anticipates an improvement in rental affordability, driven by a projected increase in vacancy rates across Canada. Fairs added that despite new immigration policies, demand remains strong, although rental affordability continues to be a challenge for many Canadians. "There is a bit of vacancy, but in the high-cost market," he said. In British Columbia, there's an evolving trend in the mortgage market where alternative lenders are becoming increasingly significant. Homebuyers are looking for more financing options, and as a result, they're turning to non-traditional mortgage products that align with their financial strategies. This shift indicates that mortgage brokers and alternative lenders are playing a more prominent role in the residential real estate sector. It's not just borrowers with cash flow issues or lower credit scores who are utilizing these services anymore. Even A clients with dual incomes and substantial down payments are considering brokers, sometimes long before they are ready to purchase a home. Industry experts have noted that alternative mortgage products, once stigmatized, are now gaining acceptance, especially for short-term financial strategies. The gap between interest rates on traditional and non-traditional mortgages has been closing as these industry players expand and become more sophisticated. However, this growth brings potential risks such as a lack of transparency and compensation, high fees, conflicts of interest, and even predatory lending practices. Eddie Cochillo, president of Dominion Lending Centers and DLCG Mortgage Group, highlighted the growth in the alternative space, stating that its presence has expanded significantly over the years. According to the Canada Mortgage and Housing Corporation, nearly half of Canadian homebuyers in 2024 relied on a broker for mortgage negotiations, which is an increase from previous years. Additionally, the value of outstanding residential mortgages held by non-bank lenders rose by 19% from 2020 to 2024, according to Statistics Canada. Rebecca Casey, president of the Canadian Mortgage Brokers Association, British Columbia, emphasized that mortgage brokers are trusted intermediaries who provide unbiased advice. They are not tied to any single brand, which allows them to offer a wider range of options to clients. This independence is appealing to many borrowers who are seeking better guidance and a more personalized client experience. Alternative mortgage products, while often carrying higher interest rates and fewer perks, can offer significant value in certain situations. For instance, individuals who pay themselves a modest salary through a corporation might not qualify for a traditional mortgage due to insufficient personal income. However, an alternative mortgage could enable them to qualify for more financing without incurring high personal income taxes. Dean Coeler, board chair of the Canadian Alternative Mortgage Lenders Association, explained that alternative mortgage products are designed for non-bankable transactions. These might include scenarios where traditional underwriting rules, credit scores, or income taxes owed make it difficult to secure a bank mortgage. Alternative lenders can also facilitate time-sensitive transactions that traditional banks might struggle to complete quickly. Despite the advantages, there are risks associated with using mortgage brokers and alternative lenders. Brokers are typically compensated through a finder's fee or commission from the lender, and sometimes they may charge fees to borrowers, especially in complex situations. The Business Practices and Consumer Protection Act in British Columbia prohibits mortgage brokers from charging fees for arranging consumer mortgages unless the fees are deducted from the mortgage advance at the time of funding. The British Columbia Financial Services Authority mandates that mortgage brokers disclose all potential conflicts of interest, including any direct or indirect interests and commissions, to ensure transparency. This is crucial to prevent unethical practices and to protect consumers from predatory lending. As Rebecca Casey from the Canadian Mortgage Brokers Association, British Columbia pointed out, working with a reputable mortgage broker can help borrowers avoid hazardous or malicious financing. In our final segment today, we have some important news coming from North Bay, Ontario. The Government of Canada and the City of North Bay are preparing to make a significant announcement related to housing. This is a development that could have implications for the local housing market and potentially offer new opportunities for residents in the area. While the details of the announcement are yet to be disclosed, it's expected to involve initiatives that aim to address housing challenges in North Bay. This could include new housing projects, financial support for homebuyers, or measures to improve housing affordability. The involvement of both the federal government and the city indicates a collaborative approach to tackling these issues. Housing continues to be a critical topic across Canada, with many regions experiencing affordability challenges and supply shortages. Initiatives like this one in North Bay are part of broader efforts to ensure Canadians have access to adequate and affordable housing. It's encouraging to see different levels of government working together to find solutions. As more information becomes available, we'll keep you updated on the specifics of this announcement and what it means for the people of North Bay. Stay tuned to our podcast for the latest developments in the housing sector across Ontario and beyond. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.